Smart Investing Made Simple, Your Guide to Market Success. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. In a world of complex financial advice and ever-evolving investment products, why do some investors consistently outperform others using surprisingly simple strategies? This paradox is at the heart of common sense investing, a method that strips away unnecessary complications and focuses on the fundamental principles that have stood the test of time. Common sense investing is not just about choosing the right stocks or timing the market, it's about understanding the inherent power of simplicity. It's about recognizing that the most effective strategies often involve doing less, not more. This approach is built on patience, discipline, and a clear understanding of one's financial goals. It leverages the benefits of broad market index funds, which historically have provided stability and growth, outpacing many actively managed funds. By the end of this book, the concept of common sense investing will be demystified, and you'll be equipped with the tools to make informed, wise investment choices. Let's begin this journey with a fundamental question: have you ever wondered what makes common sense investing differently? This question will lead us into our first chapter, where we'll delve deeper into what common sense investing truly entails and why it's considered a superior strategy for anyone aiming for financial independence. Join our vibrant community of seekers and learners by subscribing to the channel. Every subscription is a token of encouragement that fuels our ability to bring you more captivating and thought-provoking content. Subscribe now, comment, and smash the like button. Be part of the movement shaping the future of learning and growth. In the comments, please let us know what type of books you would like to read. Your feedback helps us tailor our content to serve you better. Let's begin. Chapter 1. What is common sense investing? Have you ever wondered what truly separates successful investors from the rest? Common sense investing is not a buzzword, it's a proven strategy that focuses on the essentials of investing, stripping away unnecessary complexities. This approach emphasizes long-term growth through investments that are easy to understand and manage. But what exactly constitutes common sense in investing? Common sense investing involves three fundamental principles: investing in broad market index funds, minimizing fees, and maintaining a long-term perspective. This strategy is rooted in the belief that the stock market, despite its volatility, tends to grow over time. Investing in a diversified portfolio of index funds, which track a broad range of assets, spreads your risk and increases your chances of capturing the overall market's growth. Why index funds? Index funds are the cornerstone of common sense investing because they offer a straightforward way to invest in the entire market. Unlike actively managed funds, where fund managers attempt to pick winning stocks, index funds passively track a specific index, like the S&P 500. This means lower management fees and less buying and selling, which can erode returns. Over time, these lower costs can significantly impact your investment growth. Moreover, by avoiding the pitfalls of trying to beat the market, investors can instead benefit from the market's overall upward trajectory. This is because the market's returns over long periods have historically been positive, and trying to outguess it often leads to poor investment decisions and missed opportunities. The power of simplicity. The beauty of common sense investing lies in its simplicity. Focusing on broad market index funds reduces the need to constantly monitor and adjust your investments. This passive approach saves time and reduces the emotional stress associated with frequent trading. It's about setting a solid foundation and letting the market work for you. As we continue to explore the fundamentals of this approach, you'll learn how to start building your investment portfolio based on these principles. The next chapter will guide you through the initial steps of creating a solid investment foundation, helping you assess your financial situation and define your investment goals. Are you ready to lay the groundwork for your financial future? In the next chapter, we'll dive into how to build a strong investment foundation tailored to your goals and economic situation. Chapter 2. Building your investment foundation. What are the first steps in creating a solid investment foundation? Before embarking on an investment journey, it's crucial to establish a strong foundation. This process begins with a clear understanding of your current financial situation and a thoughtful assessment of your long-term goals. Are you saving for retirement, hoping to buy a home, or preparing for your children's education? Each goal requires a tailored approach. Assessing your financial health. The first step in building your investment foundation is assessing your financial health. This includes understanding your income, expenses, debt levels, and emergency savings. Do you have enough savings to cover unexpected costs or loss of income? Establishing an emergency fund is essential before investing, as it ensures that you won't need to liquidate your investments prematurely in case of financial distress. Setting clear investment goals. Once your financial health is checked, you should set clear and achievable investment goals. These goals should be specific, measurable, attainable, relevant, and time-bound smart. For example, instead of merely saying you want to save for retirement, specify how much you want to save and by what age. Clear goals help guide investment decisions and keep you focused on long-term objectives. Understanding risk tolerance and time horizon. Every investor has a different level of comfort with risk. Your risk tolerance will largely dictate the types of investments you should consider. Additionally, your time horizon, or the time you plan to keep your money invested, is critical. Generally, the longer your time horizon, the more risk you can take, as you have more time to recover from potential losses. Creating a balanced asset allocation. Based on your risk tolerance and investment goals, you can determine your asset allocation, how you distribute your investments across different asset classes such as stocks, bonds, and cash. A well-balanced portfolio is critical to managing risk and achieving steady growth. We'll explore how to choose the right mix of assets that aligns with your financial goals and risk tolerance. As you apply these foundational steps, you're preparing to make informed and effective investment choices. The groundwork we lay here is crucial for advancing towards selecting suitable investment vehicles, such as index funds, which we will cover in the next chapter. With a solid foundation, how do you choose the correct index funds that match your goals and risk tolerance? Stay tuned as we select the best index funds to optimize your investment strategy. Chapter 3. Choosing the right index funds. Are all index funds created equal? While index funds are known for their simplicity and effectiveness, not all are created equal. Choosing suitable index funds is critical in building a portfolio that meets your financial goals and aligns with your risk tolerance. This chapter will guide you through selecting index funds that best suit your needs. Understanding different types of index funds. Index funds can vary significantly in their focus and composition. Some track broad market indices like the S&P 500, which includes stocks from a wide range of industries, providing good diversification. Others might track specific sectors like technology or healthcare, countries, or types of investments such as bonds or commodities. Understanding these differences is crucial for building a portfolio that reflects your investment strategy. Evaluating fund performance and fees. When selecting index funds, it's essential to look beyond past performance. A fund's expense ratio, the annual fee that all funds charge their shareholders, is critical to long-term investment success. Funds with lower expense ratios allow more of your money to stay invested and compound over time, leading to significantly higher returns than funds with higher fees. Diversification within your portfolio. While index funds inherently provide some diversification, combining different types of index funds can further enhance your portfolio's diversification. This strategy can help reduce risk and smooth out returns, as other market sectors and asset classes often perform differently under various economic conditions. Aligning funds with your investment goals and risk tolerance. The choice of index funds should directly reflect your overall investment strategy. For long-term goals like retirement, you might lean more heavily towards stock index funds, which typically offer higher returns but with greater volatility. For shorter-term goals, bond index funds, or a mix of stocks and bonds, might be more appropriate to reduce risk and provide stable returns. Regular review and adjustment. Choosing suitable index funds is not a set-it-and-forget-it decision. Reviewing and adjusting your investments regularly is essential as your financial situation, market conditions, and investment goals evolve. This might mean rebalancing your portfolio periodically to maintain your desired level of risk in alignment with your goals. As we wrap up this chapter on selecting suitable index funds, you should feel equipped to make informed choices that bolster your investment strategy. The next chapter will expand on these strategies by exploring how to diversify your portfolio to manage risk and enhance returns effectively. You've chosen your index funds, but how do you arrange them to work best for you? The next chapter will explore portfolio diversification and show you how to optimize your asset allocation to weather different market conditions and achieve consistent growth. Chapter 4: The Art of Portfolio Diversification. Why is diversification considered an investor's central defense? Diversification is not just a buzzword, it's an essential strategy for managing risk and optimizing returns in your investment portfolio. This chapter explores the critical role of diversification and provides practical advice on effectively diversifying your investments across various asset classes, sectors, and geographies. What is diversification? Diversification involves spreading your investments across different assets to limit exposure to any asset. This strategy helps mitigate risk because different asset classes often perform differently under the same economic conditions. When one asset class is down, another might be up, stabilizing your portfolio's overall performance. Types of diversification. Asset class diversification. This involves mixing different types of assets, such as stocks, bonds, and real estate, in your portfolio. Each asset class has different risk and return characteristics, which can balance out the volatility in your investment returns. Geographical diversification. By investing in markets across different countries and regions, you can reduce the risk of being overly exposed to the economic conditions of any single country. Sector diversification involves spreading investments across various economic sectors, such as technology, healthcare, and finance. Sector performance can vary greatly, and diversification helps protect against sector-specific downturns. Implementing diversification. To diversify your portfolio effectively, assess your current investments. Look at your existing portfolio to understand your current level of diversification across asset classes, sectors, and geographies. Identify gaps and opportunities. Identify areas where you might be overexposed or underexposed based on your risk tolerance and investment goals. Choose appropriate investments. Select index funds and other investments to fill these gaps and enhance diversification. Regular portfolio review and rebalancing. Diversification isn't a one-time task, it requires ongoing attention. Market movements can shift your portfolio away from your intended asset allocation. Regularly reviewing and rebalancing your portfolio ensures it remains aligned with your risk tolerance and investment goals. This may involve selling some investments and buying others to return to your target allocation. The psychological comfort of diversification. Beyond the practical benefits, diversification offers psychological comfort. Knowing that your investments are spread out across various assets can make it easier to endure the inevitable ups and downs of the market without panic selling, which can be detrimental to long-term investment success. As we move forward, understanding how to maintain a diversified portfolio will be crucial in your investing toolkit. The next chapter will delve deeper into the importance of understanding market cycles, an essential factor in making informed investment decisions that complement your diversification strategy. Understanding market cycles can be challenging as they often appear intricate and uncertain. However, comprehending these cycles can significantly benefit your investment strategy and complement your diversified portfolio. Join us as we delve into the influence of market cycles on your investments. Stay tuned for more insights. Chapter 5: Understanding Market Cycles. Do market cycles affect your long-term investment success? Market cycles represent the natural ebb and flow of the financial markets and can significantly impact investment returns. Understanding these cycles is crucial for investors looking to make informed decisions and optimize their portfolios. This chapter delves into the nature of market cycles, how to recognize them, and how to adapt your investment strategy accordingly. What are market cycles? Market cycles are periods when markets move from highs to lows and back again, influenced by economic factors, investor sentiment, and external events. These cycles can vary in duration and intensity, and are often categorized into 4 phases: expansion, peak, contraction, and trough. Expansion. Rising market prices and economic growth characterize it. Peak. The point at which growth reaches its maximum before beginning to decline. Contraction. It is marked by falling prices and slowing economic activity. Trough. The lowest point of the cycle, setting the stage for the next expansion. Understanding the signs of each market cycle phase can help you better prepare and respond. During expansion, signs include increased corporate profits, low unemployment, and rising stock prices. At the peak, indicators might include high valuation metrics, overly optimistic investor sentiment, and the potential overheating of the economy. The contraction phase often brings declining stock prices, reduced consumer spending, and increasing layoffs. The trough is marked by low prices and a bleak economic outlook, which eventually turns as conditions begin to improve. Adapting your investment strategy to market cycles. While it's nearly impossible to time the market perfectly, understanding market cycles can help you adjust your strategy. Expansion and peak. Consider taking some profits from well-performed investments and reallocating them to underperformers or more stable assets. Contraction and trough. Look for investment opportunities when the market is down. This can be an ideal time to buy quality assets at lower prices. The role of diversification in market cycles. Diversification plays a crucial role in managing the risks associated with market cycles. By spreading your investments across different asset classes, sectors, and geographies, you can mitigate the impact of a downturn in any single area. Staying focused on the long term. Despite the fluctuations associated with market cycles, it's essential to maintain a long-term perspective. Frequent trading to chase short-term profits can lead to higher costs and missed opportunities. By staying committed to your long-term investment strategy and making thoughtful adjustments in response to changing market conditions, you can enhance your ability to achieve consistent growth over time. As we have explored the dynamics of market cycles and how to navigate them, the next chapter will focus on maintaining discipline in your investment approach, a critical factor in succeeding through various market conditions. With a grasp of market cycles, how do you stay disciplined in your investment approach, especially during times of volatility? The next chapter will explore the virtues of disciplined investing and how it can safeguard your portfolio against common pitfalls. Chapter 6. The Discipline of Investing. What does it indeed mean to be a disciplined investor? Discipline in investing is the cornerstone of long-term financial success. It involves adhering to a well-defined investment strategy despite market volatility and emotional biases that can lead investors astray. This chapter will explore the importance of investment discipline, strategies to maintain it, and how it can lead to more consistent investment outcomes. Sticking to your investment plan. The first step in practicing disciplined investing is having a clear, well-thought-out investment plan. This plan should outline your financial goals, risk tolerance, and investment strategy, including criteria for selecting and rebalancing your investments. It helps you avoid impulsive decisions based on market noise and emotional reactions. Avoiding market timing. One of the most common pitfalls for investors is trying to time the market, which is notoriously tricky, even for professionals. Market timing can lead to missing out on significant market gains, often because the best days in the stock market can follow closely on the heels of the worst days. A disciplined investor focuses on time in the market rather than timing the market, leveraging the power of compounding over time. Using automated investment strategies. Automation can be a powerful tool for maintaining discipline. Techniques such as automatic contributions to investment accounts and automatic rebalancing can help you stay consistent with your investment plan without making constant decisions. This saves time and reduces the emotional stress associated with managing investments. Responding to market volatility. Market volatility can test an investor's discipline. It's important to anticipate these periods and have a strategy for dealing with them. This might include having a diversified portfolio that can withstand market swings or setting predefined rules for buying or selling assets during turbulent times. Remember, volatility often presents opportunities to purchase valuable assets at lower prices. The psychological aspect of disciplined investing. Discipline also involves managing one's emotions. Fear and greed can lead investors to make poor decisions, such as panic selling or hazardous investments. Educating yourself about the psychological aspects of investing and being aware of one's emotional responses can help one remain objective and focused on one's long-term goals. Continuous learning and adaptation. While discipline implies sticking to a plan, it also means being willing to learn and adapt as necessary. Continuous education about the financial markets and regular reviews of your investment plan are essential to ensure that your strategy remains relevant and practical. As we move forward, the importance of keeping costs low in your investment strategy cannot be overstated. The next chapter will delve into the impact of fees on your investment returns and how to minimize them to maximize your portfolio's growth potential. Are you aware of how much fees can eat into your investment returns? The next chapter will reveal the often overlooked impact of investment fees and provide strategies to minimize them for enhanced long-term growth. Chapter 7. The impact of fees on investment returns. Are you aware of how much fees can eat into your investment returns? Investment fees may seem small, but they can significantly erode your investment returns. This chapter explores the different types of investment fees, their impact on your portfolio, and strategies to minimize these costs to maximize your financial growth. Understanding different types of fees. Investment fees come in various forms, including expense ratios. These are annual fees charged by mutual funds or ETFs as a percentage of your investment. They cover the fund's management, administration, and advertising costs. Transaction fees. Fees incurred when you buy or sell securities. These can vary depending on the brokerage and the type of transaction. Load fees. Sales charges apply when you buy front-end loads or sell back-end loads, and they are also used when you purchase or sell shares in some mutual funds. Advisory fees. Fees paid to financial advisors or robo-advisors are typically a percentage of the assets under management. The compound effect of fees. The real impact of fees becomes apparent when you consider their long-term effects on compound growth. A seemingly small difference in expense ratios can result in substantial differences in investment outcomes over decades. For example, an expense ratio of 1% versus 0.1% on a significant investment sum can mean a difference of tens of thousands of dollars in retirement savings. Strategies to minimize fees. To keep more of your investment returns, consider the following strategies. Choose low-fee investments. Opt for index funds or ETFs with low expense ratios. Due to their simple, passive management structure, these funds often perform better than higher cost alternatives. Be mindful of transaction costs. Consider brokerages that offer low or no transaction fees. Frequent trading can also increase costs, so invest with a long-term perspective. Understand fee structures. Be aware of how your financial advisor is compensated. Advisors paid through commissions may have incentives that do not align with your best interests. Automate to avoid loads. Some funds offer lower load fees or waive them entirely for automatic investment plans. Setting up regular, automatic contributions can reduce or eliminate these costs. Evaluating total costs. When assessing any investment, it's crucial to evaluate the total cost of ownership, including all fees associated with holding and trading the investment. This total cost analysis will help you make more informed decisions and choose investments that align best with your financial goals. The role of fee awareness in investment success. Being vigilant about fees is not about penny pinching but about intelligent financial management. Choosing investments wisely and understanding the fee structures can significantly enhance your investment portfolio's efficiency and growth potential. As you become more fee conscious, your ability to maintain and grow wealth improves. The next chapter will shift our focus from the costs of investing to the benefits of compounding, the secret ingredient to maximizing your investment returns over time. Ready to see how your investments can genuinely work for you over time? The next chapter will unveil the power of compounding and explain how it can transform modest savings into substantial wealth. Chapter 8. The power of compounding. How does compounding transform your investment returns? Compounding is often called the world's eighth wonder, and for good reason. It's the process where the earnings on your investments begin to generate their profits. This chapter will explore how compounding works, why it's a pivotal element of successful long-term investing, and how you can harness its power to increase wealth significantly. Understanding compounding. Compounding occurs when the returns on your investments are reinvested to generate additional earnings over time. This cycle of earning returns on your returns continues to grow your investments exponentially, especially over long periods. Illustrating the impact of compounding. Consider an initial investment of $10,000 in a broad market index fund, with an average annual return of 7%. Without adding more money, and with the power of compounding, this investment would grow to over $76,000 in 30 years. If you add just $100 a month to this investment, the total after 30 years would be significantly higher, nearing $150,000. Maximizing compounding in your investment strategy. To make the most of compounding, start early. The sooner you begin investing, the more significant the compounding effect. Time is the most critical factor in compounding, as the longer your investments can grow, the larger the potential returns. Reinvest dividends and interest. Ensure that dividends and interest earnings are automatically reinvested back into your investments. This increases the amount that will compound over time. Maintain regular contributions. Consistently adding to your investments can dramatically increase the effects of compounding. Even small, regular contributions can make a big difference over many years. Avoid unnecessary withdrawals. Try to let your investments grow undisturbed. Withdrawals reduce the principal balance, diminishing the compounding effect. The role of discipline and patience. Compounding requires patience and discipline. The most substantial benefits are seen over long periods, and the temptation to cash in on short-term gains can be significant. Staying committed to your long-term investment strategy and understanding the exponential growth potential of compounding are crucial to achieving substantial financial growth. Compounding and risk management. While compounding can significantly enhance potential returns, managing risk appropriately is essential. Ensure that your investment portfolio is diversified and aligned with your risk tolerance. This approach helps protect against significant losses, which can severely disrupt the compounding process. The power of compounding is a fundamental principle that every investor should understand and utilize. By leveraging this powerful financial tool, you can transform modest savings into substantial wealth, providing economic security for the future. As we've explored how to make your investments work efficiently through compounding, the next chapter will guide you in adjusting your investments as you navigate different life stages. This adaptability is crucial to maintaining a compelling long-term investment strategy. Now that you understand compounding, how do you adjust your investments as you approach different life stages? The next chapter will discuss strategies for modifying your investment approach to align with your evolving financial needs and goals. Chapter 9. Adjusting your portfolio over time. How should your investment strategy change as you grow older? Stimulating market cycles can be challenging as they often seem complex and unpredictable. Nevertheless, understanding these cycles can significantly enhance your investment strategy and complement your diversified portfolio. Come and join us as we explore the impact of market cycles on your investments. Stay tuned for more valuable insights. Understanding life stages and investment goals. Each stage of life brings unique financial goals and challenges. Early career. Focus is often on growth. Taking on more risk can be more manageable because there's time to recover from market downturns. Mid-career. Financial goals might shift towards saving for children's education, buying a home, or beginning to consider retirement planning more seriously. Pre-retirement. As retirement approaches, the focus often shifts towards preserving wealth and reducing risk. Retirement. The primary goal is typically income generation and capital preservation, with a lower tolerance for risk. Assessing risk tolerance over time. Your risk tolerance is likely to decrease as you age. Young investors might be comfortable with a high proportion of stocks in their portfolios, whereas older investors might prefer a higher allocation to bonds and other less volatile investments. It's crucial to reassess your risk tolerance regularly and adjust your asset allocation accordingly. Strategies for adjusting your portfolio. Regular rebalancing. This involves adjusting your portfolio to align with your desired asset allocation. Rebalancing helps manage risk and maintain exposure to growth-oriented investments appropriate for your stage in life. Gradual reallocation. As you move closer to retirement, gradually shifting your portfolio from stocks to bonds can help reduce volatility and prepare for a more stable income stream in retirement. Life cycle funds. Also known as target date funds, automatically adjust the asset mix according to a selected time frame, typically linked to one's expected retirement age. Implementing changes with minimal impact. When adjusting your portfolio, consider tax implications. Make changes in a tax-efficient manner, such as taking advantage of tax-deferred retirement accounts or timing sales to minimize capital gains taxes. Use dips as opportunities. Look for market dips, or corrections, as opportunities to make adjustments, potentially reducing purchase prices for new positions. Staying informed and proactive. Staying informed about economic conditions and market trends can help you make more educated decisions about when and how to adjust your portfolio. Maintaining an ongoing relationship with a financial advisor can also provide personalized advice tailored to your changing circumstances. Adjusting your investment strategy over time is crucial for aligning your financial resources with your evolving life goals. By being proactive and attentive to these changes, you can ensure that your investment portfolio remains a robust tool for achieving financial security and prosperity. As we have examined the necessity of adapting your portfolio over time, the next chapter will explore another critical aspect of investing: tax-efficient strategies to maximize your returns and preserve your wealth. Are you optimizing your investments for tax efficiency? The upcoming chapter will delve into strategies for making your investment journey as tax-efficient as possible, ensuring you keep more of your hard-earned money. Chapter 10. Tax-efficient investing. Are you making the most of tax-efficient investing strategies? Effective tax management is a critical component of a successful investment strategy. It can significantly enhance your returns by minimizing the tax on investment gains, dividends, and interest. This chapter explores various strategies for tax-efficient investing to help you keep more of what you earn and grow your wealth more effectively. Understanding investment taxation. Investments are subject to different forms of taxation, including capital gains taxes, taxes on dividends, and interest income taxes. The rates and rules vary depending on your country's tax laws and tax bracket. Understanding these rules is the first step in planning a tax-efficient investment strategy. Types of tax-efficient investment accounts. Tax-deferred accounts. These accounts, such as traditional IRAs or 401ks, allow you to defer taxes on contributions and earnings until you withdraw the funds, typically during retirement when your tax rate may be lower. Tax-exempt accounts. Contributions to these accounts, like Roth IRAs, are made with after-tax money. However, earnings and withdrawals are tax-free, provided certain conditions are met. Taxable accounts. While these accounts do not offer the same upfront tax benefits, strategies like tax loss harvesting or long-term investments can minimize the taxes due. Strategies for tax-efficient investing. Asset location. Place income-generating investments, like bonds, in tax-advantaged accounts to shield their returns from taxes. Conversely, taxable accounts, such as stocks, hold investments that benefit from lower long-term capital gain rates. Tax loss harvesting. This involves selling securities at a loss to offset capital gains in your portfolio. This strategy can help reduce your overall tax liability. Holding periods. Long-term capital gains tax rates are typically lower than short-term rates. In most jurisdictions, before selling, holding investments for longer than 1 year can qualify you for these lower rates. Choosing tax-efficient funds. Some funds, such as index funds or ETFs, are specifically designed for tax efficiency. These typically have lower turnover rates and generate fewer taxable events. Regular review and planning. Tax laws and your circumstances can change. Regularly reviewing your investment strategy with a tax advisor can ensure that your approach remains aligned with the latest tax regulations and your financial goals. This proactive planning can make a significant difference in the efficiency and growth of your investments. The role of a financial advisor. Working with a financial advisor who understands the nuances of tax-efficient investing can provide valuable guidance tailored to your specific situation. They can help you navigate complex tax laws and optimize your investment strategy for tax efficiency. Tax-efficient investing is more than just minimizing taxes, it's about maximizing investment returns over time. By implementing the strategies discussed in this chapter, you can significantly enhance your financial growth and achieve your long-term goals more effectively. Next, we will shift our focus from optimizing taxes to ensuring you are well-informed and up-to-date on your investments. The upcoming chapter will discuss the importance of staying informed about your investments and how continuous education can enhance your investing success. How important is continuous learning in the context of investing? The next chapter will emphasize the value of staying educated about financial markets, investment strategies, and economic conditions to refine and adapt one's investment approach effectively. Chapter 11. Staying informed, educating yourself about investing. How important is continuous learning in the context of investing? In the ever-evolving world of finance, it is crucial to stay informed and continually educate yourself about investing. This ongoing education helps you make better decisions, adapt to changing market conditions, and ultimately enhance your investment success. This chapter discusses the importance of continuous learning and offers practical tips for staying up to date with financial knowledge. The benefits of continuous learning. Continuous learning in investing provides several benefits. Adaptability. Understanding current market trends and economic indicators allows you to adapt your investment strategies to market changes. Self-assurance. Increased knowledge reduces anxiety about market fluctuations and empowers you to make informed decisions. Opportunity recognition. Being well informed lets you recognize and act on investment opportunities that others might miss. Sources of financial education. Books and publications. There are countless books on investing, from beginner guides to advanced strategy discussions. Regularly reading reputable financial publications can also provide current insights and analyses. Online courses and webinars. Many universities and financial institutions offer online courses that range from basic investing concepts to complex financial strategies. Podcasts and blogs. Financial podcasts and blogs can be a more casual way to stay informed about the financial world. They often feature experts discussing current trends and investment tips. Financial news. Watching or reading daily financial news helps you stay informed about the broader economic environment and specific industry developments. Evaluating information quality. With the vast amount of information available, it's essential to evaluate the quality and reliability of the sources. Consider the following. On authority and credibility. Does the information come from a recognized and respected authority in finance? Bias and objectivity. Be aware of potential biases in sources, especially those selling specific financial products. Punctuality. Ensure the information is current and relevant, as outdated advice can be misleading. Implementing learning into practice. It's not enough to consume information, you must apply this knowledge to your investment strategy. This might involve analyzing new information and adjusting your portfolio accordingly. Discuss new concepts with a financial advisor to see how they might apply. They are testing new strategies on a small scale to evaluate their effectiveness before fully integrating them into your portfolio. The role of community. Joining investment clubs or online communities can provide additional learning opportunities. These platforms allow you to discuss ideas, share insights, and learn from the experiences of others, enriching your understanding and perspective. Staying informed and committed to continuous learning is as crucial as any financial strategy. By keeping yourself educated and aware of the latest trends and techniques, you can maintain a dynamic and practical approach to investing. As you become more knowledgeable about the investment world, it is essential to avoid common pitfalls. The next chapter will explore common investing mistakes and guide how to avoid them, ensuring you maintain a sound investment strategy. What are the common investing mistakes that you should avoid? The upcoming chapter will shed light on the pitfalls that can derail even the most seasoned investors and offer strategies to navigate around them effectively. Chapter 12. Common investing mistakes to avoid. What are the pitfalls that can derail even the most seasoned investors? Investing can be fraught with potential mistakes, and even experienced investors can fall prey to common pitfalls. This chapter identifies vital investing mistakes that can undermine your financial goals and offers strategies to avoid them, ensuring your investment strategy remains sound and productive. Chasing performance. One common mistake is chasing after the highest returns without considering the associated risks or the sustainability of such returns. Investors often move money into assets or funds that have recently performed well, mistakenly believing that past performance guarantees future results. Strategies to avoid this mistake. Focus on long-term trends rather than short-term fluctuations. Maintain a diversified portfolio that doesn't overconcentrate on any one asset, regardless of its recent performance. Neglecting diversification. Another critical error is failing to diversify adequately. Some investors might hold a portfolio heavily skewed towards a particular asset class, sector, or geographic region, exposing them to significant risk if that area underperforms. Strategies to avoid this mistake. Regularly review your portfolio to ensure it aligns with a diversified investment strategy. Consider various investment opportunities in different asset classes and international markets. Letting emotions drive decisions. Investing decisions driven by fear or greed can lead to poor outcomes. Emotional reactions might prompt investors to sell during market lows due to panic or buy during highs due to over-optimism. Strategies to avoid this mistake. Remains robust in varying market conditions and schedules regular portfolio reviews, at least annually or after significant life events. Stay informed about changes in the economic landscape and personal financial circumstances that might necessitate a strategy adjustment. By being aware of these common mistakes and implementing strategies to avoid them, you can enhance your ability to manage your investments wisely. Avoiding these pitfalls helps ensure your investment strategy remains robust in varying market conditions and aligns closely with your financial goals and risk tolerance. With a firm understanding of what not to do, the next chapter will focus on effectively measuring and tracking your investment success. Understanding your progress is crucial for making informed adjustments and achieving your financial objectives. How do you know if your investment strategy is working? The next chapter will explore different metrics and benchmarks for measuring investment success, helping you to make informed decisions and keep your financial goals on track. Chapter 13. Measuring your investment success. How do you know if your investment strategy is working? Measuring the success of your investment strategy is vital to ensure you are on track to meet your financial goals. This chapter will discuss the key metrics and benchmarks you can use to evaluate your investment performance, helping you make informed adjustments and optimize your strategy over time. Setting clear financial goals. Before measuring success, you must define what success looks like. This means setting clear, quantifiable financial goals. Whether accumulating a certain amount for retirement, funding education, or buying a home, having specific targets will guide your evaluation process. Using benchmarks. Benchmarks are standard tools for measuring the performance of investments. They allow you to compare your portfolio's performance against a relevant index or market sector. For example, if you have a portfolio of U.S. stocks, you might measure its performance against the S&P 500. Critical metrics for measuring success. Return on investment. This measures the gain or loss generated on an investment relative to the money invested. ROI is expressed as a percentage and helps compare the efficiency of different investments. Annualized returns. This metric shows an investment's performance over time, normalized to a yearly rate. It is beneficial for comparing returns across investments of different durations. Risk-adjusted return. This considers how much risk is involved in producing the investment's return. The Sharpe ratio, for instance, is a popular metric for calculating risk-adjusted returns, comparing the return of an investment to a risk-free rate adjusted for the investment's risk. Alpha and beta. Alpha measures an investment's performance relative to a benchmark, indicating whether it has outperformed given the risk taken. Beta measures an investment's volatility compared to the market as a whole, indicating how sensitive it is to market movements. Portfolio diversification and balance. Assessing diversification and balance within your portfolio is also crucial. Ensure your investments are spread appropriately across different asset classes and sectors to mitigate risk and exploit market opportunities. Regular portfolio reviews. Conducting regular portfolio reviews is essential. This involves checking performance and reviewing whether your investment strategy aligns with your evolving financial goals and life circumstances. Adjustments may be necessary as your goals, market conditions, or risk tolerance change. Using technology and tools. Leverage technology to track and measure your investment performance. Numerous apps and financial platforms can help monitor your portfolio, providing real-time data and analytics to aid decision-making. Measuring your investment success involves tracking financial returns and ensuring your investment strategy aligns with your personal goals and risk tolerance. Regularly evaluating your performance using these metrics and benchmarks enables you to make informed decisions that will bring you closer to your financial objectives. Next, we will explore the final tips and best practices in investing. This guidance will be crucial for refining your strategy and ensuring you remain on a path to financial security. As we near the end of our journey, what last pieces of advice can ensure your investment success? The next chapter will compile critical tips and strategies, honing your approach to secure a prosperous financial future. Chapter 14. Final tips for the aspiring investor. What last pieces of advice can ensure your investment success? As we conclude our journey through the essentials of intelligent investing, this chapter compiles essential tips and best practices that every investor should know. These guidelines will help refine your investing approach and ensure you remain on a path to financial success and security. Stay committed to your investment plan. Consistency is critical in investing. Stay committed to your long-term investment plan, despite the market's ups and downs. This commitment helps you avoid impulsive decisions based on short-term market fluctuations and ensures that your investments have time to grow and compound. Embrace a long-term perspective. Adopt a long-term perspective in your investment strategy. Historically, despite short-term volatility, markets have tended to rise over the long term. Focusing on long-term goals makes you more likely to achieve sustained growth and avoid the pitfalls of reactionary investing. Keep learning and adapting. The investing world constantly evolves, with new products, strategies, and regulations emerging regularly. Educate yourself about financial markets, investment options, and economic trends. This ongoing education will allow you to adapt your plan and make informed decisions. Diversify wisely. Diversification remains one of the most effective strategies for managing risk. Ensure your portfolio is diversified across asset classes, sectors, and geographies to mitigate risk and tap into various opportunities. However, be mindful not to over-diversify, as this can dilute potential returns. Monitor fees and costs. Always be aware of the fees and costs associated with your investments. High fees can significantly erode your returns over time. Opt for low-cost investment options, such as index funds, and choose brokerages that offer competitive trading costs. Utilize professional advice when needed. While managing your investments actively is beneficial, don't hesitate to seek professional advice when necessary. A qualified financial advisor can provide personalized guidance tailored to your specific financial situation and goals, especially in complex scenarios or significant life changes. Prepare for the unexpected. Life is unpredictable, and economic conditions can change rapidly. Maintain an emergency fund and consider insurance where appropriate to protect yourself and your loved ones from unforeseen financial hardships. This preparation can prevent you from needing to liquidate investments in unfavorable conditions. Practice patience and discipline. Patience and discipline are virtues in investing. Avoid the temptation to chase high returns through speculative investments or frequent trading. Stick to your strategic plan, focusing on steady growth and prudent risk management. These final tips encapsulate the wisdom and strategies that can lead to successful investing. By applying these principles, you will be better equipped to navigate the complexities of the financial markets and work steadily toward achieving your financial objectives. As we wrap up this comprehensive guide, the final chapter will combine all the concepts we've discussed, providing a clear, actionable plan for putting your new knowledge into practice and confidently embarking on your path to financial freedom. Are you ready to take control of your financial future? The next chapter will consolidate everything you've learned into a step-by-step action plan, setting you on a solid path toward achieving your financial goals. Chapter 15. Putting it all together: your path to financial freedom. Are you ready to take control of your financial future? This final chapter brings together all the concepts we've explored throughout this book and outlines a step-by-step plan for implementing your new knowledge. By now, you have the tools and understanding to confidently navigate the stock market and embark on your path to financial freedom. Step 1. Define your financial goals. Start by clearly defining your financial goals. Are you saving for retirement, a child's education, a new home, or perhaps building an emergency fund? setting specific, measurable, and time-bound goals will provide direction and motivation. Step 2. Assess your financial situation. Take a comprehensive look at your current financial situation, your assets, liabilities, income, and expenses. This assessment will help you understand your starting point and how much you can afford to invest. Step 3. Develop a personalized investment plan. Based on your goals and financial assessment, develop an investment plan. Decide how much you need to invest regularly, choose appropriate asset allocations, and select the investments that fit your risk tolerance and time horizon. Step 4. Establish an investment account. If you haven't already, open an investment account that suits your strategy. This could be a brokerage account, an individual retirement account (IRA), or any other type of account that supports the assets you plan to invest in. Step 5. Implement diversification. Apply the principles of diversification to spread your risk. Invest across different asset classes, sectors, and geographies. This strategy will help you manage risk and capitalize on various investment opportunities. Step 6. Monitor and rebalance your portfolio. Review your portfolio regularly to ensure it aligns with your investment goals and risk tolerance. Rebalance it to maintain your desired asset allocation, especially after significant market movements. Step 7. Stay informed and adapt. Keep educating yourself about financial markets and economic trends. Staying informed will allow you to adapt your investment strategy in response to changing market conditions and new opportunities. Step 8. Practice patience and discipline. Remain patient and disciplined with your investment strategy. Avoid the temptation to make impulsive decisions based on short-term market fluctuations. Stick to your plan and focus on long-term growth. Step 9. Seek professional advice when necessary. Don't hesitate to consult with financial advisors or investment professionals, especially when making complex financial decisions or if your financial situation changes significantly. Investing is not just about making money, it's about making wise decisions to secure your financial future. With the guidelines and strategies discussed in this book, you are well equipped to manage your investments effectively and navigate toward financial independence. Remember, the journey to financial freedom is a marathon, not a sprint. It requires commitment, a clear strategy, and an understanding of the fundamentals that drive successful investing. With these tools, you can take proactive steps toward building lasting wealth and achieving your financial goals. Thank you for listening. Elevate your learning journey with our channel by subscribing today. Each video we create is designed to challenge, inspire, and enlighten. By subscribing, you ensure you're up to date with the latest content and support our quest to make learning accessible and engaging. Your feedback helps us tailor our content to serve you better. Join the conversation below, and let's learn and grow together. Let's explore the limits of what we can achieve together. Be well and thrive.